Welcome to Introduction to Farm and Ranch Taxes.
Hi, I'm Poppy Davis. I teach a class in agricultural taxation at the University of Arkansas School of Law LL.M program in agricultural and food law. I'm the primary author of these materials in close collaboration with my friend and colleague Winona Doris. Winona is a business skills consultant and trainer who works with farmers, ranchers, and fishers. She leads training on accounting, taxation, insurance, and cash flow at both the state and national level. Winona comes to agriculture through familial ties from her great uncle, Ed Scott, who was a successful claimant in the Pigford case against the USDA. Winona holds a BA in economics and accounting, a master's in business administration, a graduate master's certificate in taxation, and is licensed as an insurance agent and a tax preparer.
And it's my pleasure to introduce my friend and colleague, Poppy Davis. Poppy is a consultant and business skills advisor to agricultural and food and beverage enterprises and to nonprofits and local governments. She has worked as a CPA and at the United States Department of Agriculture and in various nonprofits. She holds a Juris Doctorate from Drake University Law School, a master's in journalism from Georgetown, and a BS in agricultural economics from the University of California at Davis.
The LL.M program in agricultural and food law at the University of Arkansas School of Law has been a leader in agricultural and food law for more than 40 years. It has nationally recognized faculty, specially designed courses, on-campus and distance options, and for more information, you are encouraged to go to the website.
This presentation is intended to provide general information on agricultural income tax issues and should not be construed as providing legal advice. It should not be cited or relied upon as legal authority. State laws vary and no attempt is made to discuss state-specific laws. For advice on how these issues might apply to your individual situation, consult an attorney. This project and materials created by Poppy Davis as part of the LL.M program of agricultural and food law at the University of Arkansas School of Law is part of the Agricultural Finance, Tax, and Asset Protection Program.
The Ag Financial Tax and Asset Protection Program has resources to enhance farmers, ranchers, educators, and others' ability to understand and navigate business tax and asset protection decisions.
There are a total of 5 lessons in this series.
For each lesson, there's a short questionnaire to help you decide if the lesson is right for you. Each lesson also includes a PowerPoint, a recording of the PowerPoint, and a PDF file with detailed supplemental information, including the presenter's script, additional topics for discussion and engagement, and additional resources. Welcome to Lesson 4, Entities.
We will start out understanding a little bit more about business entities so we can understand the different federal income tax filing requirements for the different types of entities.
Note that this presentation is limited to the types of entities typically used by small for-profit farms, ranches, and fishing businesses. We will talk about partnerships, limited liability companies, and S corporations.
There are many other types of business entities, not-for-profit corporations, cooperative corporations, and other types of corporations. But since those are not pass-through entities, their tax requirements are not tied to the tax returns of their owners, employees, or board members.
As soon as you begin a business working with the intent to profit, you are a sole proprietor. You do not have to do anything else to become a sole proprietor. As a sole proprietor, there is no legal distinction between you and your business. That means you personally are liable for all of the debts of the business and for any legal liability associated with anything the business does. If you live in a community property state, your spouse may be liable also. This is called unlimited personal liability. The majority of states are common law states. In 9 states that are community property states, Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. Even in a common law state, if the spouse co-signs loans, the spouse will have personal liability for the debt.
Business entities were developed as a way to encourage people to take a chance on starting a business without risking all of their personal assets. Over the years, new entity types have been developed to give various types of legal protections, and the tax code has changed to develop different ways to tax the different entity types.
When there is no legal distinction between the owner and the business, the owner is responsible for any liabilities, debts, fines, or legal judgments associated with the business.
If two people who are not legally married are in business together, they are a general partnership, whether they know it or not.
Partners in a partnership have unlimited personal liability for all the debts and liabilities of the partnership. This means that any one partner can be held responsible for 100% of a debt or other obligation of the partnership, and potentially a spouse in a community property state may also be liable. A partner who has to pay all of an obligation of the partnership can sue the other partner for their share of the debt or obligation. But the point is that someone with a legitimate claim against the partnership can collect against any one partner and force any partner to use personal assets, potentially including a spouse's earnings, to pay the obligation.
Unlimited personal liability is the default when you are in business with someone to whom you are not married and do not have a formal business entity set up that limits your liability. If you are married or if you have significant personal assets, it is important to think about limiting business liability. If you are single and really do not have any personal assets, it may not be worth much to you to form a separate entity to limit liability because you do not have a lot of assets at risk.
Forming an LLC will protect you from some business debts and business-related liabilities, but will never protect you from your own bad acts or negligence. Once you have formed an entity under state or tribal law, you have to decide how you want that entity to file taxes for federal tax purposes.
For more information on the legal aspects of limited and unlimited liability, consult an attorney licensed in the state where you own property or do business.
USDA program payment limitations are per person actively engaged in farming if the people have unlimited liability, but per entity if the people are farming as a trust, LLC, or corporation. Generally, USDA program payment limitations are $50,000 for CRP and from $125,000 to $500,000 for other programs. If your program utilization is well below these limits, forming an LLC should not change your USDA program payments, but you should still work through your particular situation before forming an LLC. USDA program payment limitations are a specialized area of knowledge. Unless a CPA or attorney has specialized agricultural expertise, they will likely not be aware that forming a trust which is a common estate planning practice, or forming an LLC, a common business practice, may lead to a reduction in USDA program payments. If participation in USDA farm program payments is an important part of your farm or ranch revenue, please consult a qualified CPA or attorney with expertise in farm programs before forming any entity, including a trust or an LLC. A sole proprietorship is not legally distinct from the owner, so there is no limited liability, and the owner's tax return includes the business activity. All other entity types have something that makes them legally distinct from the owner, so the general rule is that they file their own tax returns.
For income tax purposes, it was difficult to encourage people to limit liability by forming an LLC if that meant having to file a separate tax return for the individual. For LLCs with more than one owner, it was confusing to determine if the LLC should file a partnership tax return or a corporate tax return. To simplify things, the IRS invented disregarded entities. If you have an LLC, you can elect to have the IRS ignore or disregard the LLC. For federal tax purposes, a single member LLC can be ignored. The owner files Schedule F or Schedule C. An LLC with more than one owner must file a partnership tax return. That is the ignore or disregard option, or it can elect to be taxed as an S corporation. That's the IRS version of simplified.
If you form an LLC, you need to make a federal tax election in the first year you file taxes after you have formed the LLC. If you want to be taxed as an S corporation, you have a short window. You need to make the S corporation election within 2 months and 15 days from the first day of the S corporation's accounting year. Usually that's the calendar year, but it may be a fiscal year. If you do not want to be taxed as an S corporation, you may elect to have the LLC treated as a disregarded entity for tax purposes. This election is easy to make. You just file taxes as if you had not formed the LLC, either as a sole proprietor if there is only one owner, or as a partnership if there is more than one owner. More on S corporations in a minute. If you form a single member LLC and are not electing S corporation taxation, you are electing to have the LLC treated as a disregarded entity for tax purposes. You still get legal liability protection for state law purposes, but for federal tax purposes, it is like the LLC never happened. It is a disregarded entity. The one exception is for married couples who were filing taxes as a qualified marital joint venture so that both spouses can pay into the Social Security and Medicare system. In that situation, if they form an LLC and do not elect S corporation taxation, they must file taxes as a partnership. We will discuss other situations where the LLC will file a partnership tax return on the next slide.
Example, my brother and I farmed some fields together, and each of us farmed some fields on our own. We just file our own tax returns and split the income and expense on the fields we farmed together. Is that okay? No. You are a business together with anyone other than your legally married spouse. You must file a separate tax return for that business. The default is you are in a partnership. Even if you do not know, you may be a partnership if you work together with the intent to share profits. So you would file a partnership tax return. The better option is to make an active decision about forming a partnership with a written partnership agreement, but consider unlimited liability, but access to maximum USDA program participation, or to form an LLC with limited liability, but with some restrictions on USDA program participation. Under either of those options, you may elect partnership taxation. Under the LLC option, you may also consider S corporation taxation.
Why is this important? If you have a taxable profit each year, there might not be much difference in taxes owed if you file a partnership tax return, if you each file a Schedule F reporting your share of income and expense. If you have losses, failure to file a partnership tax return may result in you paying the wrong amount of taxes. That is because there are detailed IRS rules limiting how partners can take partnership losses against other taxable income.
Prior to the 2017 Tax Act, the S corporation alleviated some of the burden of paying self-employment taxes and income taxes. Generally, for people who were consistently earning approximately $40,000 a year or more going on payroll, and deducting payroll taxes as a business expense resulted in inadequate payments to Social Security and Medicare and minimized overall total federal taxes. That was before Qubit was invented. Now that we have Qubit, it is more difficult to determine when electing S corporation taxation is beneficial. In general, S corporation taxation is no longer beneficial unless the owners consistently pay self-employment tax on approximately $150,000 a year or $300,000 a year for married couples.
If you are close to these amounts, you should consult a CPA for assistance in determining if S corporation taxation would benefit you. You also need to consider how federal S corporation taxation might change your state income tax burden. There are special rules for assets you take out of an S corporation when you end the S corporation's existence. If you are considering forming an S corporation, be sure to consult a qualified EA or CPA and think about long-term plans and goals as well as short-term objectives. If an S corporation is no longer the best tax structure for you, consult a qualified CPA or EA for assistance with filing a final tax return for the entity.
C corporations are beyond the scope of this presentation, but they are rarely a good entity choice for small-scale agricultural operations or land holding. Thank you.
There are additional resources at the links in your resources.
You can also get information through IRS Publication 225, the Farmer's Tax Guide, resources on ruraltax.org, or go to the IRS website and look at its forms and publications. These are also great additional resources.